So hey, let's jump in. Welcome. We're going to get started here. We're going to jump into a couple things here. Before we get started, I want to share with you guys here two things. I'm looking here to my right, and I want to bring to your attention those that run around Launch, or if you're new to Launch. We have started this new series here, and thanks to Rachel working on this and the graphics and kind of working with me on this concept that we're rolling out. So this is kind of the first one under the umbrella, and we're titling these Learn at Launch. So matter of fact, I was just talking with Chris. We have another one tomorrow on a different topic, but I'll share with you at the end of our session. But this one today is Valuing the Future, and we're going to be talking about practices for valuing early stage companies. So if you're in the wrong place, feel free to get up and walk to that door if that's not of interest to you. But I think most of you are in the right place. So excited to have you guys here, and looking forward to talking about that. But I want to go ahead and get started. We're going to start here on the end, and we're going to go through. The other thing before we get started, let me back up. I do want to say a quick thanks to our sponsor, our partner, Clifton, Larson, and Allen. Appreciate you guys, our partnership, year 2 now, so thank you. Appreciate you guys coming up and sharing your expertise. So this is going to be a good hour session here. One thing for you guys, we're on microphones. The reason we're on microphones, we're recording. I got 2 microphones out there on the table. So our plan here is that I have some good questions that I've shared with the group. We're going to kind of go through this. If you guys have questions, just kind of raise your hand and we'll go through them as we're going through. That's no problem, or you can save them to the end. But I do ask that if you have a question, just grab the mic, power it on, and talk. That way we can capture it in the recording. So that's why they're out there. So if we get over here on the outside, we'll just make sure we get microphones over there. So all good? All makes sense? So let's get going. Again, I'm David Bowling, Director for Launch Fishers. I'll kind of moderate here. I am not the expert, so that's why I have these 3 gentlemen with me. So I'll start on the end, and Chris Whirling, who is the founder of Connection Point Software, and I'll let Chris kind of give his background and why we have asked him to be up here on the panel with us.
All right, I'm Chris Whirling again, and so my background, originally from Fort Wayne, big city of Fort Wayne, came to down south here, but went to Rose-Hulman, got a computer engineering degree years ago, joined a national consulting firm doing implementations of software, and then we started our own supply chain management consulting firm, myself and some other guys having left that company. We also did cybersecurity as well. We had a separate company doing cybersecurity. So if you know of Pondurance here in town, other big ones, we were the predecessors before them. We sold in 2005 to a much bigger company now known as Optiv. That our core group is their group here in the Midwest. And sold the supply chain management company eventually as well. And then just recently, in recent years, started Connection Point. My wife, who is in the audience here actually as well, for you those who are listening and watching later, she started selling for a direct sales company called Norwex. And I jumped in and was helping her with her business and really saw a need in that industry in social selling to help them following up with their customers, helping them be able to keep and grow their existing customers. And I saw that was almost non-existent in that industry. And I'm used to, from corporate America, we know that it's important to keep and grow your existing customers. It's far more costly to get new customers. So started just creating a spreadsheet for her, and the spreadsheet turned into software today, a few years later. So we've been in business for about 4 years, and I personally funded it for the first few years, and now we've been doing some fundraising ourselves, and we'll talk about that a little bit as we go along here today.
Thanks, Chris. Travis, go ahead.
Great. It's a cool story, Chris. Pleasure to be up here with you and David. Appreciate the invite. It's a pleasure to be here with all of you, and thanks for coming this morning. So my name is Travis Chamberlain, and I'm a principal at CLA. And I've been at CLA my entire working career. So I graduated from Ball State, grew up in Warsaw, Indiana, graduated from Ball State in 1998. Went to work for what was then Clifton Gunderson, and through a merger, we became Clifton Larson Allen, and we go by CLA to shorten that. And I've been there my entire career. So what do I do at CLA? So what I do is business valuation. So I help companies figure out what they're worth when they don't have a traded price. So we work with a lot of closely held, family-owned businesses. And we'll get into a little bit more of what we do and who we do it for and why we do it. But I work with businesses kind of all along the spectrum of life cycle in all kinds of different industries. But I also focus a lot in the tech space, helping to value technology companies. So I will pass it over to my colleague, Andrew.
Hi, everyone. Andrew Godfrey, also with CLA. I've been with CLA for coming up 3 years now, also in the business valuation group. Prior to that, I guess I graduated from Indiana University and graduated in 2015, and out of school had a job in valuation at Ernst & Young, doing valuation there for about 4 years. And then decided to go in the corporate setting for a few years and doing some corporate development work and M&A work for a publicly traded company, and moved back then to Indianapolis, and have been doing business valuation ever since with CLA. And to Travis's point, have done it really across a wide variety of industries, but industry focus within CLA is the technology industry. So nice to meet everybody, and looking forward to having the discussion today.
Well, let's jump in. So set here, the premise of this was, I know some of you that are in the audience. Obviously, I know Chris and bring him up here. The thinking was that, knowing you in the audience, where you are and trying to raise money, trying to set a value for the business. I also know the VC side and trying to fund the business and all those things. And what's the value of the business? How do we put that target in that value on the business? And as I was talking with Travis and Andrew, I thought, you know what? Maybe we should do something and talk about, that independency. Let's get someone that's not the founder, the co-founder. That's not someone that's the VC. Let's have a discussion about how do we do it from an independent standpoint. How do we do that where, you guys can walk away with, oh, if I were just called in or we called somebody that's independent, what are some of the strategies and the plans that go through? What are the valuation processes? What's out there? What's unique? What's independent? And that's how we got here. And then as we said, well, as we start getting through this process, these guys said, well, you know what? You probably ought to have someone that's going through this to kind of give a real-time experience, what's happening. And so we said, why don't we bring Chris up a little bit? So just to kind of, as we go through this, this is not a chance really to, Chris is not going to divulge everything of what he's going through, so that's really not open for, some of that is kind of private to him, but we've asked Chris as he can kind of share his experience and what's happening with him. So that's kind of how we got to where we are, and we hope that, if we hit on things that are important to you. As I said, I know some of you are thinking about raising money and all those things. So let's get started. I'll jump in, start going through some questions that I have here of the panel, and then if you guys have questions, raise your hand, grab the mic, and we'll get after it. So I'm going to start off, Travis, Andrew, and just kind of real quick, just kind of lay the groundwork for us of background of type of work. Travis, I think you said it, of lots of companies that you guys do, that you do valuations for, this ABV accreditation that you have. Where do you get involved? Give us kind of a synopsis there so we can start rolling.
Yeah, I can start it off here. So as I mentioned, we at CLA, maybe I'll take a step back. With CLA, we have 9,000 professionals all around the country, and CLA is really a professional services firm. So think audit, tax, various outsourcing services, digital solutions, and valuation falls within the outsourcing group. But the way CLA goes to market is truly by industry focus, right? Within valuation, just kind of how projects and engagements come to us, unlike an audit that you might have 1, 2, or 3 audit clients that you work on throughout the year, Travis and I could be working anywhere between 10 to 20 valuations at once. So we work on a lot of different clients across a lot of different industries as well. So the types of valuations that we could perform, right? So There could be a 409A that might be something that this room has heard of. It's more private company valuation for tax purposes, and oftentimes it's used to help support the fair market value of issuing options to employees. So we do that type of work. We also will help businesses with buy-sell type agreements. Potentially looking to sell your business, you're just looking to understand the value of your business, right? We also do valuations for gift and estate tax purposes as well. So gifting shares, or somebody passes away, valuing the estate for estate tax purposes. So that's kind of more on the tax side of things. And we also do a lot of work with financial reporting type valuations. So, company A buys company B, and we'll be engaged by company A, and we'll value the target and really value the intangible assets coinciding with the transaction. So think of things like intellectual property, customer relationships, patents, developed technology, and the such. So do some of that, goodwill impairment type analyses, and then some stock-based compensation work. So think of profits, interest, stock-based awards. So that's the arena that we typically fall in.
You got it. So Travis, a lot of us, most of us here are in, tech, software as a service, marketing strategy, tech. Is that a lot of, give us a kind of that vertical deeper dive there in valuation process and where your experience is there and what happens in that kind of that industry?
Sure. So both Andrew and I have a focus on the tech industry, and tech can be defined very broadly or very narrowly. When I say tech, a lot of times what I'm talking about are SaaS companies, software companies, and then within software, we tend to work with a lot of B2B software companies. So that's kind of where we have more exposure and experience. And in terms of point of life cycle for the company, I mentioned this earlier, but we really work with companies all the way from kind of the startup, Series Seed, Series A, all the way up through pre-IPO. And then we work with a fair number of publicly traded companies that still have valuation needs, even though they're publicly traded and you can look up their stock price. They still have other things that they need help with in terms of valuation for financial reporting, tax purposes, et cetera. So really, we serve companies all along that life cycle. And usually in the earlier stages, from a valuation perspective, our focus is primarily in assisting with stock-based compensation. When you're an early stage startup company, a lot of times you don't have a lot of cash to compensate your employees. And so, employee stock options can be a means of providing compensation that's non-cash and aligns incentives so that your employees are incentivized to help you grow the value of the company as a founder. And so we support companies with helping to set a strike price on those options that is equal to fair market value, so they don't get into trouble with the IRS with deferred compensation.
Let's real quick talk about, we're going to jump into probably some calculations and methodology, but talk a little bit about just real quick on storytelling and how that plays a role for you guys in valuing a business and what you believe, and that advice here for storytelling of an entrepreneur and a co-founder.
Sure, that's a great question, David. So maybe it would be helpful to set the stage with just some first principles with regard to valuation, just kind of fundamentals valuation 101. The first thing I would mention is that valuation is always forward-looking, right? So if you think about what the value of a business is, you can summarize it as it's the present value of the future cash flows that business will generate through its life, right? And you might say, well, gee, I'm a startup company. Does that really apply to me? I would say, yes, it does apply to you. It applies to you a little bit differently, and you have to apply that principle a little bit differently to a startup company because of the unique risks and characteristics, which we'll get into. But investors are always interested in the future, right? You're always trying to assess as an investor what the prospects are for that business to generate cash flow in the future. and you're trying to, make calculated risks and apply judgment to, hopefully pick winners, especially in the startup early stage investment cycle. But you're assessing, what the future cash flows are, and then you're discounting those future cash flows back at a risk-adjusted discount rate. Now, not every investor does the math that way, but at the end of the day, investors are paying for the future. So, David, your question about storytelling is really important, because when we're valuing mature companies, a lot of the story has already been told. There's a lot of history for a mature business that's been operating for 30 years in the same industry. And while investors are, betting on the future, they can use history to help inform what that future looks like, right? And it's important to understand sort of what the vision is for the company, even though it's mature. It's important to understand what the management strategy is to grow the business, to improve margins, increase cash flow, et cetera. But you have a lot of history to rely on. When you have a startup company, you don't have that history, right? You don't have a lot to look back on to say, what's the likelihood of this venture being successful? The startup may be founded by a serial entrepreneur, so maybe you have a history of that entrepreneur being successful in founding companies and growing them, but you don't have history on that specific company. And so the founder's ability to really tell the story in a credible fashion is extremely important. So the stronger you can make the case for why you're going to find product market fit, why you're going to be able to execute on that vision that you have successfully, is really important and is a key driver in the valuation at that startup early stage. So,
Real quick, what's your feeling and your advice to the audience here of how soon should you start telling that story?
I think you.
And who should you tell that story to?
Yeah, I think as soon as you feel confident in that story and in articulating that story in a meaningful way where it's going to be believable, you should probably start sharing that story and start sharing it early and often with key stakeholders that might be future investors. Now, you don't want to get ahead of it because you don't want to start sharing that story too early when people can poke a bunch of holes in it. So, but find mentors, find people that you trust that you can share that story with, and ask them to poke holes in it, right? And kind of play devil's advocate on why they, or what you can improve in terms of how you tell that story. Yep.
Chris, real quick, what's your comment there on when did you get into realizing that, hey, I need to start sharing my story and getting out, raising money, get out there and start talking to people?
Yeah, so my situation we're a SaaS company, software as a service. For me and for us, it was a little bit unique. A lot of SaaS companies are started by business people or people who see the need but don't really have the experience to do the software development. I had not done software development for a while, but I actually came to 1150 here and took a class in 2020 to update my skills for modern web app development. And then, because I had the money to hire software developers, I outsourced some of the software development as well. So I was able to fund it by myself for a while, and had the technical expertise and understanding to be able to do some of the work and do the designs and stuff like that myself. So I didn't need to really raise money early on. But as soon as we were done with MVP, the minimal viable product, and also even version 1, then it was obvious we were growing quickly. We were getting a lot of people excited about our software. And so at that time, I felt it was ready, time to raise the money to really scale it at that point. That was 2 years ago. We just started raising money recently, so there was a gap of about 2 years, unfortunately, because we went out to some of the VCs and angel groups, and were literally had on the schedule pitches to pitch our business to them. And my co-founder, a lady who I'd worked with for many years, found out that she had stage 4 breast cancer. and it just pretty much killed going forward with doing fundraising. Because I know that one of the big things that VCs and others look for is the team. That's one of the biggest things, is the team. And so I said, hey, I might be good, but it's just me now again. So I really kind of need to figure this out, need to kind of start developing a new team. And so I put a pause on fundraising and just continued to do it myself at that time. Now, just an update on her. She lives close to the Cleveland Clinic and has gotten excellent care there, and it looks like she may have beat the cancer at stage 4. That's awesome. Now, I've even gotten some updates recently that there's some tentative progress there, so we're a little concerned again. She has not, as most people would do, she just cut out everything. She said, the only thing she had young kids, only thing I'm going to do is focus on my health, trying to beat this cancer, and my kids and my family. So she was not been a part of that whatsoever. But now we've built up a team, and felt it was right time, and so we're out doing fundraising and raising some capital at this point.
So clearly, the message for all of us is really, you got to get started, get out in front of this. Don't get too far out in front of your skis. You don't want to get to where you can't tell a story, you can't finish the story, but yet be prepared for things that may happen you can't prepare for.
Yep.
So let's move on. Let's get into this, a little bit here, guys, of, kind of what we're all here for. And let's dig in a little bit of what are the, walk us through a little bit. We got the whiteboard, maybe we may get into that. What are some of the primary, some of the primary methods you guys look at or use for valuing some of these? Let's call them, we're talking about early stage company. Early stage, we talk about pre-revenue companies. We're transitioning from this early stage. We're going to move into, if we're going to raise money, now we're going to have goals and responsibilities. So let's walk through and high level, if you want to dive into some strategy a little bit.
Yeah, sounds good. Yeah, and as Travis mentioned before, the value of a business is based on the present value, the future cash flows. At a very high level, that's what it is. There's a lot that goes into that, of course. But really that approach of present valuing future cash flows back to today is really more of what's called an income-based approach to valuing a company or an interest, whatever you are valuing. So that, of course, entails developing a forecast, which for pre-revenue companies or even very early stage companies, Series A, Series B, can be very difficult to do, right? Of course, with a lot of certainty as well. Now, a forecast can be, as rosy or as, it can be as doom as anybody would, it's up to the person who puts it together, right? So they're just numbers. Now, it's understanding, the risk in those numbers, right? So it's really having the conversation with the business, with the founder, to understand what the risk of achieving those cash flows are. So when you look at valuing an early stage business, one approach that us valuation professionals take is, we might receive a forecast, right? And it could just be, one forecast. But we need to understand, of course, the risk. Is this a rosy picture, or is this a downside case scenario, or is this more like expected case? Well, we're trying to get to expected cash flows at the end of the day, right? So we might consider 3 different forecasts, right? One where the company, 5 years down the road, takes off, and I just threw out 5 years. It could be any number of years, but high trajectory, that hockey stick forecast, and that might be, one forecast. One might be more that expected case, and one might be, well, after a year or 2, we might have to close the doors, right? Then we take a step back and we try to assess the probability of what those are, right? To get to really what that expected cash flow is. And then from that point, it's applying that risk-adjusted discount rate. There have been many studies on kind of what a typical return is for venture capital, investments, depending on the stage of the company and the life cycle. And that's something that we always consider as well when coming up and determining the ultimate value of a business. Now, that's just one approach, though. That's really the income approach. Looking at more of a market approach to value, I think, is also very critical. And not just looking at one approach in a vacuum to come up with a value. So when it comes to pre-seed or pre-revenue type companies or seed stage companies, it is very difficult to determine a value, right? It is an art. And so that's why we want to look at, recent transactions or investments that have occurred in the same industry with potentially the same size of revenue, or if they don't have revenue. It's a lot about kind of how you articulate that story. What's the addressable market, that's out there, right? How many entrants are in the market, and all those things too. But typically we'll look at more of a market approach and look at, what those pre and post money valuations came out to be for that stage of the company. And really that last approach that we would look at is more of a cost-based or asset-based approach, which, I would say oftentimes is not used, but that's more of, if you just think of your total assets minus your total liabilities, it's kind of that net asset value or the costs that you've put into the business up to this point, and what would, more of that market participant come in and require as a profit, right, for coming in and for all those costs that have been invested, so more of a markup on those costs. So those are really kind of the three main approaches that we would look at for valuing early stage companies. And Travis, you had anything to add?
No, I think you summarized that really well. I would just make a couple of quick, highlight a couple things really quick, and getting a little bit more back to first principles. First, when we talk about value, we're talking about a point in time value, right? So why is that important? Because it's really about what's the value of the business today, right? Which is going to be a function of expectations about what it might be worth in the future, right? But it's really about what is the value today? And then what do we mean by value, right? So we think about value as essentially like an exit price, meaning if you were to sell the business today, how would the market value it? At what price would it sell? And why is that distinction important? It's important because a lot of founders have internal beliefs about what the value of the company is, right? And I don't want to generalize too much, but a lot of founders might have a belief that the value of their company is greater, right, than how the market might value it. So when you're thinking about valuation and what is the value of the business, it's not what is the value to a specific person, including yourself. It's really how would the market value your business, and at what price would the business sell if you were to sell it on that specific date. Does that make sense? And then the other thing I would highlight again is that I don't want to oversimplify what Andrew and I do, but like valuation really comes down to three primary factors, and that is cash flow, growth, and risk. I feel almost obligated to write that on the whiteboard since we have it over here, but maybe I will. Yeah, maybe I will in a moment, but I like to draw pictures. I actually requested the whiteboard, so. But when I think about valuing a business, to keep it simple, it always is going to come down to cash flow, growth, and risk, right? Now, how do those three factors impact value? Well, all else equal, the more cash flow the business generates, the higher the value, okay? Similarly, all else equal, the higher the expected growth rate in that cash flow or in that business, the greater the value, right? So higher growth, higher value. This is common sense, right? It's intuitive, but it's important to say it. Conversely, risk has the opposite effect on value. So all else equal, if you have two businesses, otherwise identical, they have the same expected growth rate, they have the exact same cash flow that you're starting with. If one has higher risk with regard to that future cash flow, it's going to be valued lower than the business with lower risk. So risk has an inverse relationship with value, all else equal. Does that make sense? And so if you have been working in, the tech space, right? And you've talked to investors, or you've talked to friends who've sold businesses, or you've kind of thought about the value of your business. You probably haven't thought about what's the present value of the future cash flows my business is going to generate. You've probably thought about what's a reasonable multiple on my annual recurring revenue, on my ARR. It's a common metric with SaaS companies. So then the question becomes, well, Travis, you just said that it all comes down to cash flow growth and risk. Like, people don't value software companies based on that. They value based on an ARR multiple. Well, what I would propose to you is that the difference between a company that just sold for a 5 times ARR compared to one that just sold for 10 times ARR is that the company that sold for 10 times ARR probably outperforms the company that sold for 5 times ARR in one or all of those 3 components. They either have a higher expected growth rate, or they're more profitable, so they have higher cash flow, or maybe they have a great management team, maybe they have a great moat around the IP in their company, and so they have a competitive advantage, and so they have lower risk to executing on their strategy. But those 3 components, cash flow, growth, and risk, explains the difference in multiples between companies, right? It may present itself in different ways. So lower risk might relate to a better management team. Like you said, having a great team around you is important. Lower risk can relate to having high competitive advantages, right? Having a great moat around the company and the IP in the company. But at the end of the day, to get down to fundamentals, it's really differences in cash flow, growth, and risk, right? So if I'm thinking about, as a founder, right, how to maximize the value of my company, and not to skip ahead, but if I'm thinking about how to maximize the value of my company, I can really break it down into those 3 components. A, how can I increase my growth rate, right? B, how can I reduce risk? And C, how do I increase my cash flow? And what do I mean by that? Just to kind of dive into cash flow for a minute, because a lot of you might be thinking, shoot, I just put together a pro forma for 5 years and I don't show any positive cash flow because I'm reinvesting all my earnings in growth, right, in sales and marketing. So what do you mean by cash flow? Well, eventually, that business, you want to build a model so you can scale it and eventually become cash flow positive. If you are not able to do that, then it's going to be pretty hard to convince investors why they should invest in your company, because ultimately the value of that business is the value of the future cash flow. So you can look at examples of, like Airbnb, didn't make money for years, right? Now I think they're generating, what, $4 billion in free cash flow. But it took many years to get there, and it took many, I think, hundreds of millions, billions of dollars in order to fund that company to get it through the growth stages for it to become profitable. But why did investors invest in that in the beginning? Because they had a belief in the story. They had a belief that that business could eventually become wildly profitable, create an amazing moat around it, right? And generate a lot of profits. So not every investor invested to stay along for that entire ride until they became profitable, but they invested because they believed at some point that they could exit that business at a much higher valuation than they invested, right? So again, it all kind of comes back to the principles of, the value of the business is based on expectations around the future. And what drives value? It's cash flow, growth, and risk. Does that make sense? So again, not to oversimplify what Andrew and I do, but at the end of the day, that's usually what it comes down to, is our assessment of those 3 factors.
Very, very good. You just covered all my questions. I think we're done.
Okay,
No.
drop the mic.
I feel like I want to pause here because, not to put anybody on the spot out here, but somebody's probably going through this in a real sense. And I have this sense of, someone has this question of, I'm struggling, and I wrote this down. We've talked about this. I've gone through this of, living in this world of income-based and where you're trying to project income. You're projecting, you're talking about 1 year, 3 year, 5 year to get back to discounted cash flow versus a market analysis. And me as the co-founder, the entrepreneur, oh man, I'm so pumped up on this business. Look at all these numbers. Look what I can do. And you slide this across the table and you're putting it out to 3 or 4 potential investors, and they come back and it's not what you expect. And so you're trying to figure out, well, where's the disconnect? or I don't want to say the disconnect, but where am I missing it? What's the real life? Where's the meat in the middle? Of is it the income base that's the best? Is it the market analysis? I think the answer is going to be it's something both, but it's interesting. We're not going to have the answer up here. No one's going to get to, but it comes back to, cash flow growth and risk. But is there any feedback of anybody going through this real time of kind of the dynamics of the conversation? Any input, thoughts? Because it's a unique discussion. I guess maybe it's just titled negotiation, right? And is what it is.
Yeah, I mean, just to add some perspective on that from the investor point of view, and I'm not. I think Andrew and I probably both share a little bit of the imposter syndrome in that neither of us are tech startup founders and neither of us are tech investors. But we do work with a lot of startup companies. And one thing you have to keep in mind if you're dealing with investors is that, I mean, if I had a sort of investment strategy, right? And I told you that 75% of the time your investment is going to go to zero. What degree of skepticism would you use in evaluating your investments, right? And sort of what would your sort of bias be coming into any conversation with a new investment opportunity, right? You'd probably have a pretty high degree of skepticism, right? You'd probably ask a lot of questions, and you'd probably be really trying to dig into those investments to figure out what can I do to increase my win rate and get it above 25%, right? Well, venture capital, it's, the statistics are kind of all over the place. It's hard to track them and get reliable information, but the statistic that a lot of times you hear thrown out there is that about 75% of companies that are funded by VCs end up failing and they don't return their original investment, right? It's a pretty high loss rate. And so venture capitalists, have to spread their investments over, they don't just invest in one company, they're investing in multiple companies. They're placing bets and they're doing a lot of diligence to try to pick winners. And they're trying to figure out what makes a company more likely to be a winner, right? And they're trying to push their bets towards those companies that they think are winners. And so when you put a pro forma in front of them or a forecast, they're automatically thinking, okay, there's 75% chance this isn't going to work, right? Right? And so your job is to really convince them why it is going to work. And they have to believe in you. And that's why that storytelling is so important. And when I say storytelling, I don't mean making stuff up, right? I mean building a case for why they should believe you that this is going to work, or why it has a higher than 25% chance of working. So just keep in mind that skepticism that you might feel when you're pushing forecasts in front of people is grounded in experience, and it's experience that a lot of these investments fail.
I'm going to go to Chris real quick. I'm going to come back to you guys, but Chris, it sounds like we know kind of these popular valuation methodologies, and was there an opportunity for you along the way to think about and go through knowing these models of how you could increase your valuation or that likelihood and what you were talking through in getting yourself prepared for this conversation and being on point for these discussion topics?
Yeah, I like how he talked about the three main things over here, and as he was continuing to talk, I was thinking about those three things, and saying, by the time we started going out for fundraising, we had number one, we had cash flow, and we've been cash flow positive until just recently, when we've kind of said, okay, even ahead of the investment, I started investing more money into it and hiring more people and growing it more quickly. So it has the capability of being cash flow positive right away again. So it's not as much of a issue. It's the growth and risk is really what we get to show for a SaaS-based company, show that this should have a good multiple. The risk, one of the things being my successes as a part of other teams on cybersecurity and supply chain, having successes there, putting together a good team right now. But also, this was born out of a real need. A lot of times, it's kind of like, well, what, and I've been thinking about that for years. I mean, okay, what am I going to do next? What's my next startup going to be? And couldn't think of anything, couldn't find anything. And this just dropped in my lap because my wife needed real help. She was one of the top salespeople for the company, number 7, 2 years in a row for Norwex. Couldn't keep up with. Yes, exactly. She rocked it. She rocked the sales side. I had the business knowledge to be able to help her out with the business side of things, and she was drowning in her success, basically. And so I came alongside and helped her out, and then everybody else was like, hey, how are you doing all these things? How are you being successful? And they would ask her different things, and it would come around to customer follow-up and things like that. She's like, well, my husband created a spreadsheet for me. And they're like, well, we want that spreadsheet. And so it kind of dropped in my lap that this opportunity is a very real need that we have developed in a microcosm right now, and we're very much B2C right now. But we know from my past experience, it's all B2B. My past experience and some of my team's experience is all B2B. We're kind of new to this B2C thing. To some degree, I really don't like it all that much. It's kind of not fun when you're used to B2B. But looking at the growth, we know this is going to become a B2B. And and we've proven already on a B2C model. Now we just need to take it to the B2B, and we can show where the market is at today, what the growth potentials are for the future as well. And we have gotten interest from the B side, from the enterprise side already. And to show that to potential investors is one of the things that we have done as well, is telling the story of why those businesses, why the enterprise would want our software, given the challenges they have today, which are very real.
I want to ask you guys a question. So you may have you're valuing a company, you've gone through an income-based model, you've gone through a market model, and you said, hey, here's the value of the business. And then you've taken a step back and you've looked and said, but there are some things that are going to negatively impact this business. What may be some of those of words of wisdom or cautionary tales, or maybe some good things that could add on to help the value, just things that you can share that be careful, pitfalls that could hurt your value?
Yeah, good question. And I think that understanding and having the discussion, with our client, right, in the valuation kind of on upfront, one of the first things we always ask as part of, the management interview is very, very simple question. Tell us about your business. And, going back to the storytelling topic, that story in terms of who that target audience is you're telling that story to might be a little bit different, right? If you're talking about it with your marketing team, it might be a little different than having that discussion with your grandma, right? Or you're approaching that to an investor, right? And having, those discussions with investors might include things like discussing potential exit strategies that you might not discuss with your grandma or your marketing team, right? But really as part of those conversations is when you really get to understand and have a list of kind of what are those perceived risks, right? Or also what are the things that company might be doing well relative to the industry. And I'd say like the pitfalls, they're unique to each company, right? But with regard to, more the positives, it's kind of gaining that traction. What it kind of to the point of, have you already started to sign up customers? Do you have contracts in the door? What is that total addressable market? Do you have that low churn rate, right? Like those type of things that, as part of the valuation and assessing risk, right? Those things are truly important. high or low customer concentration, that can certainly impact risk as well. So like those types of characteristics of a company can really have an impact on the valuation. But then, of course, if you're looking to raise money, oftentimes those are a lot of the same questions that investors will ask too. And I know we were talking about, the risk side of things, and, you might be pitching to, various venture capitalists. And each venture capitalist might have a different perception on risk, right? And what risk they're willing to take to invest in your company, right? So it might not be the same, right, across each investor that you talk to. And that's why I think it's important to build and develop that network early on, right? And there will be, maybe potentially the harsh criticisms that you can learn from with those conversations. But I think having those conversations early on to really kind of help develop your story, right? And build on that. And then once you start to evolve as a company, start to have those positive characteristics, right? You can start to intertwine those into your story as well. And I think it's really, it's how you articulate that story to your target audience at the same time.
I'll generalize a little bit on and kind of follow on what Andrew was saying. I think one pitfall you can fall into is product market fit. Just have you thought through whether your potential customers are going to want and be willing to part with money to purchase your product, whatever it is, right? So have you really identified a need? I think your story is really on point there in that you firsthand experienced the need, identified a way to fix it, and developed a product around that, right? So, that developing or having that vision around product market fit, thinking through it, not doing that, well, obviously that's a pitfall, right? Because you could develop a great product, but if there's a need for it, there's no problem. You've created, a solution without a problem. Having an overconfidence about how long it's going to take for you to get that product market fit and develop that product and get it to market is another thing. A lot of founders underestimate the time it's going to take to develop that product and get it to market. I think another thing is I want to understand that the founder has thought through the intensity of competition, right? Because you could right now have a great product market fit, right? But it's going to take you 2 years to get it to market. And there could be a lot of other people chasing that same problem with a solution. And have you thought through the intensity of that competition and what impact it's going to have on you, right? Have you thought through the competitive advantages? Have you thought through how difficult it's going to be for other companies to create a solution similar to yours or one that might have advantages over yours, right? So have you thought through that future competitive environment that you may create? So I would say, it's product market fit, overconfidence about how long it's going to take to get your product to market, how much money it's going to cost, and then have you thought through that intensity of competition that you might experience once you develop it? Would be some of the pitfalls that we see.
Very good. I do have a question here, and I think for the audience, many of you guys, you're aware of SAFE agreements and convertible notes. It's common vernacular amongst all of us. So let's just role play here a little bit that I'm a founder. I've entered into a SAFE agreement. My question would be: has that hurt me in any way? How has that impacted me going forward in this process? Is that I'm not setting a value necessarily for the business, but what's your comment on someone that's entered into a SAFE agreement and now 6 months down, that's passed, I'm 6 months down the road and I'm now looking to raise money?
No, great question. And just to take a step back, so a SAFE agreement is really it's a simple agreement for future equity into the future, right? Or the opportunity to convert into equity. So oftentimes we see a lot of SAFEs issued. I would say typically at the very, very early stage, maybe prior to your first priced round, right? Or it can be more of a bridge to get you to the next round, to that next price round. So those are really the two times that we often see safes. And just to say it too, a safe is, issue the safe, you receive the money, but it's not on the cap table when that safe is issued, right? It's an agreement for future equity. It's not equity at that time, nor is it debt. It's not debt. It does not have a set maturity date, an interest rate. Again, it's an agreement for future equity. So when is that time for that future equity, right? So really the SAFE agreement was really adopted, founded by Y Combinator back in 2013. You can go on their website right now, download that document. It's like 5 to 7 pages long. And really the benefits of SAFEs are really the ability to execute and transact on that in a very quick manner, right? You don't need to go through the legal process of everything that goes along with a price round or even a convertible note for that matter. It's much more simplistic way to receive funds in a quick manner. So with the SAFE, right, you issue the SAFE, and typically the ability to convert that SAFE investment into equity is upon what's called a triggering event. So more often than not, that is usually dictated on that next price round, right? Or it could be, some dissolution or winding up of the company or some type of exit event. It's most often though that priced round, right? And so why would an investor want to invest in a SAFE versus potentially a convertible note or waiting for that next price round? Well, to incentivize the investor, there are things such as valuation caps, which are typically the most prevalent in SAFE agreements, or you might see a discount. And they're really they're similar in a sense, but really, from the company's perspective, what are things that I should be careful of before, signing the dotted line and receiving the money, right? Well, if you set your valuation cap too low or your discount too high, you can have very unanticipated dilution down the road at that next price round, right? And so those I think are the critical components. So although a SAFE does not set a value for the company, that valuation cap that is set in the agreement does have, can put you in a situation, let's say, if you set that valuation cap too low and that next price round comes in at a valuation 2, 3, 4 times what that valuation cap is, then that investor will be able to convert into equity and receive a certain percentage of your company that might be much greater than you initially expected. So it's always very, very careful. It's always, as the company, you want to be very, very careful of the terms within that agreement. Knowing the ability to receive a SAFE investment is very easy, and oftentimes you do need the cash, but be cautious because there is that dilution impact that can be unexpected.
Does that make sense? That's almost like a whiteboard. You need.
Yeah.
I know we're running out of time here a little bit. I feel like, there's some, are there questions? You guys have questions? Nicole, you got a question? Go ahead, fire away. All right, let me get you the mic here. Go ahead, Kurt. Record. Yep, power that on there.
There we go. Hello, thank you. My name's Nicole, and my company right now is pre-seed, pre-revenue, pre-everything. Over the past few years, we've had numerous conversations with VCs, even though we aren't at that stage, and pretty much across the board, they're all like, incredible idea, love it, talk to us when you get $1 million AAR. And unfortunately for my co-founder and I, we aren't technical, so we can't just hurry up and build the MVP and then raise from there. So we know what our best option is to go after angels. And I think that may have been one of the best explanations that I've heard so far of a SAFE. But how do I value my company for angels? Is it with a safe? How do I tell them? Period, question mark. I don't know.
It's a great question, and I would say, at the front end, I know I mentioned too, it's, depending on the angel investor, their risk appetite might be different in terms of kind of the value they might set by the amount of investment and the percentage interest they would want in your company. That's it is a tough question. I would say in terms of like setting a value for your company, a safe is not really the way to set the value for your company. I think it really does come down to those three key metrics we have up there and understanding, pre-revenue. It's really coming down to that growth and the risk, but also looking at things like, market comparables too. So that could be on something such as, PitchBook, Crunchbase, Capital IQ. There are a lot of great databases that, have great company descriptions, the market. You can find the total addressable market. You can also see kind of what those pre and post money valuations are to just use as more of a benchmark, right? It can be difficult to get the information on what those smaller companies are, right, and what they truly do. So always take caution with that, but it is a good benchmark. And also what I would say is, and it sounds like you've already been doing it too, is really developing that network with angel investors and venture capitalists now. They have that firsthand experience of investing in pre-revenue companies, right? And the value of your company, as Travis mentioned too, it's more a point in time estimate, but if you wait a year or two, well, that market might be different. That the total addressable market could be different. I mean, there are many things that can change year over year. So a value that you might estimate for yourself might not be, the value even a month down the road, right? There's always things that change. So it's taking a lot of things into consideration. But going back to the safe part that you mentioned. It's trying to negotiate and understand, I would say, and keeping in mind that dilutive impact that can be down the road, and being very, very careful of what's in the agreement there, to not, put yourself in a corner down the road, right? So trying to have as favorable terms as possible there.
Do you have anything you want to add, Chris? Okay. I'll draw a picture since we have the whiteboard and 30 seconds to draw a picture. So,
yeah, we got to use it.
Yeah, we got to use it. So I'm going to just kind of try to simplify this a little bit. And I'm going to draw these two axes, right? And this is going to be time, and this is going to be value over here, right? So we're trying to measure the value of your company here at time equals 0, right? That's today. It's a point in time estimate. But what's really going to drive that value, right, is going to be out here, right? We'll call this T plus 6, right? 6 years to get your product to market, fully developed, get it commercialized and all of that. So think about this as like your exit value, right? When you go to IPO your company, right, take it public, or you go to sell your company to a strategic investor, or you sell it to a private equity firm once it's mature, this is the value out there, right? So what you're trying to do is sort of think about how big this might be, right? What's your value if all the stars align, you build the product, you get the funding, right? How big of a value could you have out there? Right? Like what's your total addressable market? What percentage of that market do you think that you could capture? And what's a reasonable, say, multiple on that value, right? And then what you need to think about is that in order to get there, you're going to have to raise a bunch of money, most likely. You're going to have to go through multiple rounds of investment. You're going to bring in new investors onto your cap table. And so your percentage ownership is going to be diluted over time. Now, that dilution is not necessarily bad dilution. That's dilution that's going to allow you to get from here to here much quicker. And it's probably going to grow this to a larger pie, right? But you're going to have to think about, if I expect my company could be worth $200 million in 6 years, I'm not going to own 100% of it, right? So all of your negotiation here and along the way is determining how big of a slice of the pie you're going to have. However, the quicker you raise that money, the faster you get your product to market, the more you can, the faster you can drive the growth, the larger the value of the company, right? And so what I would say is that you want to focus on understanding what this value might be in the future, also understanding how much money you're going to raise, right? And the value today, so we'll make it a much smaller circle. That's all going to drive the value today, right? What is the value in the future? What's your probability of success? So PS would be probability of success. And then 1 minus that is your probability of failure. So we know that your probability of failure is going to be greater than 0, right? So you want to try to drive your probability of success higher, and that's going to drive a higher valuation here. So the more you can convince investors that A, there's a large exit value here, B, you know how to get there, and C, there's a higher probability of success, the higher the valuation here, right? And you can actually run the math. So you could say, look, I think this is going to be worth $200 million in 6 years. I think, we're going to have to raise X amount in order to get there. And then you could present value that amount that you're going to own of that at a discount rate, right? And you can solve for what the value is here, right? Now, the math calculations may or may not convince an investor. So what you really need to focus on is sort of just convincing the investors that this is big, right? And you understand that you're going to have to raise money to get there, right? And you've got a team, you have an idea, you've got a good competitive advantage with your product that's going to drive this probability of success higher. That's going to drive this from a very small number to maybe a larger number today. Does that make sense to help kind of conceptualize it? All right, I got to use the whiteboard. There we go.
It's interesting. What is the, I don't really know, what's the average raise? How many times do you raise money to get to an exit? Is there a number on that? Is it 4? Is it 5 times?
I think it depends. So
there's a lot of factors in it, obviously, but
look at examples. I mean, typically it's like friends and family, and then Series Seed, and then you go to Series A, B, C, D, sometimes E, F. Sometimes you have bridge financing before like an IPO or an exit. But it's usually 4 to 6 rounds if you're successful. Now, your probability of failure is much higher in the early rounds. So Series Seed, I don't know the exact statistics, but you may have like a 75% chance of failure. When you get to Series C, you might have like a 95% chance of success, right? So your probability of success increases, and your valuation should increase along the way. But investors are going to want to stage their capital investments. They're going to want to fund you through the next milestone, through the next value creation event, and they don't want to give you all the money up front, right? So it's a way of sort of like reducing the risk of their investment, as opposed to giving you, $50 million up front. They'll give you 500 to start.
Any other questions, comments? We may be wrapping up here. It's a good discussion, time well spent. I learned. Chris, I thank you for participating. Good luck to you. And Travis, Andrew, thank you. Thanks for your time. And let's wrap it up if we don't have any other comments or questions.
All right. Thanks, everyone.
Thanks, guys.
All right, thank you.
Appreciate it.